When gold and silver hit new all-time highs earlier this year, that may have been the opportunity of a lifetime to sell, according to my guest, Mike McGlone, who believes that gold, silver, and commodities in general are not the place to be in 2026, as he sees a large decline across the commodities complex. He also believes there's massive danger in the S&P and the broad market. He expects a correction there. What will that do to commodities, and what is his long-term outlook on the space? All of that and much more ahead. And guys, this Saturday, June 27th, the very first Commodity Culture Live Bootcamp at 1 p.m. Eastern Time. I'm going to be talking about what I'm buying, what I'm selling, and opening up my portfolio. Sign up at join.jesseday.ca. And now, Mike McGlone. Mike McGlone, great to have you on Commodity Culture. I want to start things off with gold because you tweeted recently that January to February may have been an opportunity of a lifetime to sell gold. Walk us through your thought process here. As we sit here today, we're seeing the precious metals markets take quite a hit, particularly silver, which I want to get into in a moment. But when it comes to the long-term trajectory for gold, let's say over the next 2 to 5 years, do you still maintain that this was an opportunity of a lifetime to sell, or do you think the long-term trajectory will ultimately be higher?
Well, absolutely the latter in gold. Long-term trajectory will ultimately be higher, but it could stay in this range for 10 years if history is a guide. If it's similar to 1980, 20 years potentially. But first of all, thanks for having me on. It's a pleasure to be on. I love playing show and tell. No denial about that. But I only put that out because there's so many people still bullish this asset that gave you the best year almost ever, best year ever in a disinflationary environment last year. And those of us who've been bullish and long gold for decades, sometimes you have to just say you're supposed to be selling when they're yelling. So let's look at facts right now. 60-day correlation between gold and the S&P 500 as we speak on June 23rd is about 0.7. That's the highest ever. Okay, my data is only since 1975. That's right after we came off the gold standard in 1971. So it's pretty much maybe ever. Okay, so that's a bit of a problem, which means also if you look at gold versus a basket of treasuries, U.S. treasuries or a U.S. Treasury bond index, right now the price is actually it's finally potentially bottoming, or treasuries are potentially bottoming at the lowest versus gold, like gold at the highest versus a basket of treasuries since early 1980s, since his bonds like 1986, since a basket of treasuries since 1983. So anybody who's advocating bullish and long gold positions right now with that U.S. Treasury long bond bumping up against 5%, it's got major trends working against them, and they're probably the ones who didn't say sell above 5,000. I mean, I'm sorry, but that's just the way it is. I spoke to people, Jesse, in January and February I hadn't spoke to for a decade, and it's so hard for them to remove themselves from gold, and I was one of them. Sometimes you're supposed to be selling when they're yelling. So now where do we go from here? Everybody will tell you the fundamentals. I get it. Okay, debasement, dollar, and all that stuff. China's central banks are buying. All the stuff we pointed out 5 years ago. The key thing is I was wrong on gold breaking above 2000 and 2020, 21, 22, and 23. 4 years I was wrong. So I took the pain and finally it broke out. But now it's just one of those things that goes up too much. You have to watch out. You have to be careful. And certainly when the masses jump on board. And that's where we are right now. Like I said, correlations are high, prices are elevated, and everybody usually jumps out. And there's always a good reason. But people who write books called The Big Print, I say, well, we just had the biggest print in history. Now we're in the hangover. Look at where right now is the Federal Reserve has to focus on price stability because they were too easy with prices for a while. In the stock market, the highest versus GDP in about 100 years. And people point out high debt levels in the U.S. Debt levels are half of the stock market cap. In fact, the stock market cap is double the U.S. debt sovereign debt levels. That's the highest since 2007. That's the last time the long bond reached 5%. So my bias this year is gold was great. Last year I was lucky to be on board that trade, and my bias this year is just good old U.S. Treasuries, potentially U.S. long bonds, probably going to take alpha.
Well, I want to talk about treasuries a little bit later, but first, is there any level that gold could get to on the downside where you would look at that as a potential entry point if it got back to that 3,000 level, or do you think that that could potentially be catching a falling knife?
Yeah, exactly. Well, I pointed out 4,000 was the first good support. It's a round number. I just published on that recently. I said it's probably not a bottom. It's supposed to bounce. Sure, it's supposed to bounce. But to me, the whole precious metals look very similar to what cryptos looked like last year. Now, as far as levels, 3,500 is a key level. I think 3,000 definitely. 3,500 is where we built that base last year, which was one of the best signals I've ever seen for literally 3 to 4 months, from like February to August. It just almost 5 months. It just stuck in that range. It gave great signals and broke out. So we always go back to the base. But most long-term moving averages, like 60-month kind of things that usually hold support in the long term, 10 years, are basically below 3,000. But those things are moving upwards. It just right now, I had to put that tweet out to make it clear that I noticed today there was a lot of stuff that hit the tape. A lot of these major houses are pulling back in their gold estimates. I'm like, yeah, sorry, but when markets blast off like that, you're always supposed to be doing a little bit selling when they're yelling. And as far as where it's going to go, we'll see. But we have to see how things change. The problem is right now, gold is a sock puppet to the stock market. The whole metal sector is a sock puppet to the stock market. And you're saying today's the 23rd, S&P 500 is down 1%. Gold's down about 1.5%, and silver's down about 4%. Copper's down 3%. We're all sock puppets now. That's just the way things are because the stock market's so elevated. But we also have a Fed who potentially is pointing out they need to be vigilant against price stability and inflation, which basically is hint for me means if stock market goes down, it'll do the job for them, which means it pushes everything down, including gold. Gold is now also another key thing about gold is 180-day volatility is about 2 times that of S&P 500. That's not a store value. That's a sign of gold shifting to a highly volatile speculative risk asset. And the last time it was this high was basically 2007, and that was kind of a signal that probably getting out of risk assets back then. Basically, it's also signaled that stock market volatility is way too low versus gold, crude oil, copper, and silver.
Let's talk about silver because we're now getting close to that $60 mark. A lot of people were surprised it even got to $50 when it was around $30. This is a metal that moved farther and faster than gold, getting up to around, I think it closed at around $116 at its peak. Interestingly, when I was at a conference around that time, there was somebody selling silver bullion, and I saw somebody I was with pull out their card to buy some. And the thought in my mind was, what are you doing? I almost instinctively knew at 100 and some odd dollars, this feels overpriced. And sure enough, we saw things fall, but I think perhaps it fell more dramatically than many were expecting. What are your thoughts on the silver market? Do you think it follows along with gold just in a more volatile fashion? Does it have different characteristics because of its industrial use? Would love to hear your thoughts.
The world's changed for silver. Remember, it's called the devil's metal for a reason. I used to have hair, been trading silver for decades. I put it on my prudent short this year, list this year, including Bitcoin and copper, when it got above 100. Because to me, the only way silver is going to go higher if the stock market went up much more, and that's already shifted. So it was basically be a prudent short. As we speak, it's around 65, 62, as we mentioned. But it's fully shifted. Silver's different now. It's no longer anywhere near a monetary asset. You can use it for coins, but it's much more of an industrial metal. In the past, when I've really started looking at it, when I was at ETF Securities, we had silver products, it was much more precious. Now it's all industrial, or mostly industrial, and that's the incremental demand increasing. And so first of all, you got to be bullish copper, you got to be bullish China, got to be bullish demand. Everybody's going to point out solar and all the demand stuff that we pointed out years ago. But the key thing to remember about any commodity, most notably things like silver, is there's a supply, demand, and price model. People forget sometimes when price shifts exponentially at the greatest pace in basically 40 years versus most moving averages. Silver in January reached the highest ever versus crude oil. It reaches the highest ever versus copper. Those are pretty good sell signals. But when it shifts that much, it shifts supply-demand balances and usually puts in a peak, an enduring peak that might last for decades. The last time we had a similar overbought, I don't like to use that term so much, a similar stretched period was 1979-80. It peaked around peaked around 50. We punched up there again in 2011, and last year's low was 32. That's what can happen in silver. It's just the way it works. So I think it's going to be stuck in a range. I think 50 is the first good support. Most longer-term moving averages coming around 30. But I think silver is just going to be. Here's a key thing to look at. I think it's silver and gold. I think they're going to do what crude oil has done for the last 20 years: stick in a range, get everybody bullish near the upper end of the range, like we did in crude oil this year, and then go near the lower end range, get in bearish, and just trade that range. But buying and hold these metals, most notably precious, most metals, have just reached up to much levels that typically it shifts the supply and demand balances. And that's a key thing when people say you're ignoring fundamentals. And I like to say, well, no, it's not. Never ignore the most volatile part of any supply demand model, and that's price. And price shifted, and it's shifting supply demand back towards unfavorable prices. So my levels for silver, yeah, maybe near 100, maybe near 50, knock around there for a while. But I think it's going to do what crude oil has done for the last 20 years, just not going to range for an extended period.
Commodity Culture is hosting our first live boot camp Saturday, June 27th at 1 p.m. Eastern Time. We're going to take an in-depth look inside my portfolio, A to Z, what I own, why I own it, what I'm buying, what I'm selling, and the framework through which I'm viewing the commodities sector right now as geopolitical instability, global conflict, rampant inflation, and central bank money printing continues to ramp up. Natural resources will be the winner in the years ahead. I'm going to explain why, share the greatest insights I've absorbed from all the guests on this program, and so much more. So join me for the Commodity Crisis Playbook Bootcamp, Saturday, June 27th at 1 p.m. Eastern Time. Sign up using the link in the description below. You've also written recently that commodities may have begun a 2008-like decline. If we're looking at the Bloomberg Commodity Index after that crash in 2008, it has never returned to the peak before the crash. This is a similar question to what I was asking about gold, but do you think that will play out again? And would you look at this decline as a potential buying opportunity? So I guess just take the question I asked about gold and silver and apply it broadly to the commodities space. Will there be upside in the long term? Or will commodities in general bounce around in that range you're speaking of?
I do think we put in a significant peak. The Bloomberg Commodity Spot Index, which measures spot prices, did make a new high. It's bound to drop from new highs. The total return is different. That's when you have to hold and roll those futures. And you almost always have to pay storage. That's why I always say if you're bullish, if you want to hold commodities physically over time through rolling futures, stick with the metals. And that's why I asked our index team to launch a Bloomberg All Metals Index about a decade ago, which has been the best performer, just typically the way it works. But the overall commodity market, never forget one key thing about commodities. Most of all, they're mostly energy-based. Energy, the Bloomberg Energy Spot Index reached a level this year that it first traded in 2005. That's 20 years ago. I just pointed out it's good resistance. It's going to be sticking in that range for maybe another 10 years. You look at agriculture, we can create more with less every day. Those got anywhere near the highs we got like in corn, soybeans, and wheat got back in 2022. The only sector that made a new high this year in commodities is precious metals on the back of gold and silver. And guess what's the main sector down in the year right now? Precious metals. They're down 5%. That's a sign of an enduring peak. So the key theme right now is we are all sock puppets, particularly commodities, particularly the metals to the U.S. stock market, completely. The most in maybe 100 years, Jesse. The correlations are high. You have to be completely dependent on that stock market going up for crude oil to continue going up, for the metals particularly to go up. I'll be presenting at a metals conference in British Columbia after we speak today virtually. And I'm going to have to point out, sorry, if you're bullish metals, you better be bullish the stock market because they ain't going up unless stock market goes up, and the stock market reached basically almost a 100-year high versus stock market to GDP. It's 2 times the market cap to, 2 times U.S. debt, which is pretty high. It's high since 2007. So that's the thing, is we've reached a bit of an end game. And also now we have a situation where in the last 2-3 years, U.S. stock market and commodities, broad commodities, have been going up basically on the same chart syndrome, almost in the same upward trajectory, and we've reached that plateau of inflation being a problem. And I point out, energy has not really been inflation. I pointed out just a minute ago, the energy spot prices have bounced to a level first trade in 2005. The key thing that's driving inflation now as part of that end game is the rapid wealth creation of the U.S. stock market, the most in 100 years, 2.6, 2.5 times GDP. And I think finally the Fed's getting it. Mr. Trump's getting it. The facts have changed. If you're a incumbent president or Republican or leader now, you better not pressure the Fed to ease, because that's more likely to have more inflation. It's more likely you're not going to be elected, and more likely the next president going to be a Democrat. They get that. And if the stock market goes down, that means you're probably going to get a Democrat. But the key thing for commodities is got a number one focus on China. China's in a pretty severe deflationary recession. Just look at their 10-year note yield at 1.74 versus 4.5 in the U.S. I've been pointing that for a while. And we just saw a good test with crude oil. It did what I hoped it and what I expected it to do. It pumped up to near 120 in WTI. Now we're back as we speak down at $73, right at the bell. Basically the apex of the bell curve for 20 years. It's right in the middle. It's probably going to go on the lower end of the range. And why did that? Partly because we heard of a release from China from their SPR, which they've been accumulating for the last few years, probably from Iran. But it's just a normal elasticity of highly elastic commodities. The key thing to remember is, most notably in energy, rapidly advancing technology is hurting both sides of supply and demand. It's reducing demand, just the fact that my EV is 12 years old. In China, you can buy EVs that are quite effective and cheap now. Well, at least the rest of the world can, not the U.S. And it's also creating that more supply every day. So I look at commodities as very much like I did in 2008, pumped and dumped. So I'll end with this. The pump and dump syndrome is gaining contagions. At the beginning of the year, we had Bitcoin and natural gas. They were the first ones that pumped and trickled down on the year, and they're kind of warning us. Now, joining that party is gold, silver, platinum, palladium, iron ore, and corn. I think by the end of the year, it's going to include copper, particularly if the stock market's down. Copper is highly correlated to the stock market. And crude oil. Crude oil is on that trajectory. And the key theme for bottom line, I point out, Jesse, is if you're bullish commodities, right now you have to have that stock market go higher. And they've been way underperforming for a while. Just the last few years caught up a little bit.
The counter argument to that is how a lot of people are saying that there will be a rotation of capital. I know you've heard this story as well. It's one of the narratives out there that's fairly persistent, that in the event that the stock market experiences a severe correction, goes into bear market territory, capital will be leaving the overvalued tech space and will be looking for somewhere to go. And what better place to go than hard assets? So in the event of that happening, we would then see commodities and related equities become the beneficiary. And alas, the commodity cycle, super cycle, will begin. What are your thoughts on that narrative?
Good luck with that one. It's completely false and untrue. Capital doesn't leave, it disappears. And when it disappears, you get post-inflation deflation. Now, I mentioned already a few markets that are doing that. We're getting that in China. The property crisis is as bad as it was in Japan in the 90s, starting in early 1990. But when stock market goes down, I didn't say if, it's way overdue. You just destroy capital. It just disappears. It doesn't go places. But one key thing it does is it produces deflation, which leads me back to my original statement, is I think the best trading potential performing asset this year will be U.S. Treasury long bonds. I made that statement well over 6 months ago. We were 6 months into the year. Haven't been right yet, but now it's all starting to trickle that way. Because if the stock market goes down, you're going to see major pressure on virtually all commodities. It might not affect the grain so much, but because we're so financialized now, the stock market's so high. It is the economy at 2.5 times GDP. If the stock market drops 20%, that's 50% of GDP. That's severely deflationary. So I just want to point out some of my research. It's very similar to me in 2008 and 9. We looked at the crude oil peaked at 147, CPI peaked at 5.6%, and then by 2009, crude oil had dropped down to like 30, and by 2009, CPI was minus 2%. One key fact. Stock market went down. If the stock market goes down, I fully expect CPI next year to be negative and zero. And the Fed will ease, but there's not going to be anything much they can do about it because we're at the end game. We've reached that. When you have Mr. Trump even saying that Mr. Walsh can do what he needs to do the right thing, that is a major shift from the president who's never, I've heard anything say something about bullish the stock market. But he knows now, if you're bullish the stock market, that means great inflation, you're unlikely to get elected. And commodities, as far as that rotation to commodities, like, yeah, good luck with that when the world's changed. Maybe some of the metals, maybe some of the precious metals, but I just point out how expensive they are. That's why I tilt over to my default for this year is U.S. Treasury long bonds, and I'm a commodity guy. So far, even look at grains. We can create more with less. We have a major glut of grains, most of that potentially happening in the Americas. We have shifted price maker status in crude oil and energy from Middle East to the Western Hemisphere. U.S. in the middle, Canada down to Argentina. That's a major pressure factor. And if stock market goes down, it's basically a global recession. We're that expensive. So that's very bad for commodities. So I stick with that key theme, sticking with good old Treasury bonds this year and see how that works out.
So before we move on to the broad market and Treasury bonds, are there any areas of the commodities complex that you're bullish on for 2026 and perhaps a longer time frame out to that 2 to 5 year time horizon?
Yeah, that's a key tough one. A key question. I haven't had it. I've been looking. I haven't had a major area I looked at. The only thing I really looked at. So I had prudent short levels at the beginning of the year. One of them was initially Bitcoin around 96. I moved that down to 75. Initially, it was around crude oil. Silver around 100. I moved that down to 85. And these are just, I don't trade. I don't make recommendations. Just looking at prudent levels. The number one I've been wrong on is copper. I thought it was a decent prudent potential short around 6 because to me the only way it was going to go up if the stock market goes up, and right now it's up the exact same as the stock market. It's like $6.14. So still stick with that one. But as far as place to buy, I don't know. I'm looking for levels to do that. And the key levels are you have to get to a low price cure. So basically what we have incomplete cycles. Crude oil was beating, just hovering on its US dollar U.S. break-even costs, which is the largest producer and net exporter. That's an oxymoronic statement in history, but that's where we are now. That's around $55 a barrel. So I fully expect if it gets down around 40 and gets really beat up, that'll probably be a buy. Same thing in corn and soybeans. Corn's break-even cost is just below 4, around 3.90. Gets down there for a while, that might be a buy. Soybeans, if it gets down around 9 or so, that might be a buy. Silver, maybe below 50, I don't know. Gold, I'm still kind of hemming and hawing, playing with that one, see how it works out. But no, not yet. I haven't really found any. That's why I think the only key thing I think that was worthy of a buy and hold for a long term so far this year was that U.S. Treasury long bond and went above 5%.
So let's talk about treasuries, because we're hearing a lot of bearish sentiment out there regarding sovereign debt in general. People believing that yields are going to keep rising. And of course, Japan being the poster child for a country whose bond yields are getting to historic levels at this point. Why the long bonds? Why do you think that will outperform up ahead? And are there any other areas of the bond market that you're looking at, whether that would be sovereign debt or commercial paper?
No, just that's basically my background. I started in this trading pits in Chicago, the Treasury bond future pit, in 1988, and I started when when JGBs were trading well above 5%. Now they're 2.6%. So finally, it's nice to see a little bit of a reversion in there. But you really expect that to continue in a country that is declining population, it has no immigration, and is getting hammered by these cheap EVs from China. I mean, there's the whole model shifting. They have to export. Japan has no hope really without exporting. They don't have a demand pull economy. So I'm fully demographics do not favor that. JGB staying much above 3%. Right now it's 2.6, and I look over at China, 1.73. So I think that Japan needed a bounce, but so far as sustainability, good luck. Just imagine if U.S. stock market drops 20% and stays down for a little while. That's all these things are going to drop 100 basis points in the world, most notably U.S., because that's the demand pull engine of the world. I mean, just look at Europe getting hammered now by all the cheap EVs from China and the deflationary forces that they're exporting. So and I love the sovereign debt argument. So let's start with sovereign debt. Debt to GDP in Japan is about 250%, and that 10-year note yields is 2.65. Debt to GDP in China is about 300%. Their money supply is running almost double the U.S., near $50 trillion, and their 10-year note yields 1.74%. So sure, that could happen. U.S. monetize the debt, buy it, and by the way, then the one thing that matters certainly for the U.S. and debt, and it's inflation expectations. If the stock market goes down, that's all that matters, and the debt will probably go up, but that long bond at 5% will probably, go back down to 3%.
Let's talk about the broad market, because many analysts have pointed out that it appears tremendously overvalued by a number of metrics. And of course, the SpaceX IPO feels a little bit like peak bubble territory. This is a company trading at 100 times sales, reporting billions of dollars of net losses. Do you see any further strength ahead in the three big indices? Do you think we're due for a correction? If so, how bad could it get? Would we head to full on bear market territory? How long would it last? How are you viewing the current state of the broad market?
Well, it's the dependency on the stock market to go higher in the U.S. is the highest I've ever seen, certainly in about a century. If I look at metals, great, metals are fine, all the metals, most notably the Bloomberg All Metals Index, as long as the stock market keeps going up. And let's look at S&P 500 as beta, up at about 9% of the year. Even crude oil, metals need to go higher. So even somewhat soybeans, because they're basically an oil, and soybean stock needs to go higher. But I like to quote Jim Chanos, and then he recently pointed out, finally with these IPOs and SpaceX, supply is meeting demand in the U.S. stock market. And I use him because he really helped me nail being short or bearish. I don't trade Bitcoin last year by pointing out the silliness of strategy near $400. And as we speak, it's about $100. It's probably going to zero. It's just silliness of some of that unlimited supply in a space like that. But I think the key theme to remember about the stock market is I've been wrong forever on stocks, but I found great alternatives in Bitcoin. It was a tremendous alpha provider, and then I found over time great alternatives in gold. I mean, the spot price of gold is the same versus the S&P 500 total return since 1997, meaning the store value trades a lower volatility, at least historically. This rock has been staying steady with the stock market that long. Now I think it's probably over, but oh yeah, so it's all that matters, and that's why I lean over to Treasury. So here's a key factor this year. For it's a midterm year, the last two down years for S&P 500 were midterm years, 2018, 2022, and the key theme, Jesse, that I'm really concerned about is we've never had volatility surge at such high velocity in gold and silver and crude oil and copper, with it staying so low in the S&P 500. And I pointed that out earlier. 180-day volatility in gold at 2.2 times the S&P 500 was the same signal I got in 2006 and 7 when I started getting really bearish the stock market, just by simple indications of volatility. And I pointed out that's volatility correlations are the highest 60 days ever. Gold to S&P 500. So to me, this is just an accident waiting to happen. And the prudent thing is just get out, try not to hedge, and find alternatives. And that's why I'm sticking with that Treasuries for now. And I think when that thing starts moving, it's going to be nothing to stop it. And I think it's not a when, it's an if. And it's just probably getting started. The 100, Alan Greenspan passing away at the age of 100. He was my, I just remember in the trading pits, he was I just enjoyed his mantra, his nomenclature and his speeches. It really helped me make some good money back then with clients. But no, this to me is near the end game. We all get it. It's just a question from what levels and how and where. Maybe it's starting now, the summer doldrums where you least expect it. So also another key thing, the best leading indicator on the planet has been Bitcoin. Bitcoin gold ratio led the way up and it's collapsing. And I think Bitcoin and cryptos collapsing are just a front running what's going to happen in the stock market.
And so in the event of a large correction in the stock market, would you be keeping dry powder on the sidelines to take advantage of certain price levels in certain securities? And would you even be considering, the S&P itself, some of the big tech stocks, commodities, anything else in the aftermath of a large correction? Where would you be looking to pick up the pieces, or could we be in for a Japan-style lost decade?
I think more the latter. It's always good to have prudent. To me, I looked at this year as a prudent, responsive trading year. I mentioned some of those levels already. Selling Bitcoin, the first move around 96, selling silver above 100, selling copper around 6, selling crude oil above 100, some things like that. But I don't know how long, but I do think if history is a guide, this should be a long time. You always want to be looking for opportunities. But the key thing I've been pointing out, Jesse, on the chats and with clients for all years, it's a trading year opportunity of a lifetime. Like I mentioned, first of all, we had, down years, and we had pumps and dumps in Bitcoin and gold. I'm sorry, Bitcoin and U.S. natural gas. Now that includes all the precious metals: gold, silver, platinum, and palladium, iron ore, and corn. I think that's just getting started. So right now it's one bridge at a time. I think it's a time to just stay away, look for, look to trade the market and worry about that when it comes. But the whole concept of just buy the dip, the Fed's there to save you, is way overdue to just get beat up for a decent period of time, which probably means a couple of years. We're just so overdue for that. I mean, it happened very well in 2000 and 2002. It took a little while and finally recovered. And yeah, everybody says, oh, you're supposed to just be in for a long haul. But when we're way overdue for another 50% drawdown in the S&P 500. But this time it might last a long time because, again, we're at 100-year highs. And also a key theme is sometimes you get some great signals. And when Mr. Trump mentioned Herbert Hoover a couple times in his when he was talking about Iran and the agreement he made with Iran last week, I was a bit shocked by that, because when he was elected in 2024, I wrote about his timing was very similar to Herbert Hoover's, who was elected in 1928. It just had bad timing. Stock market just reverted because it went up too much. We're just so overdue for that. And the thing is, right now at 2.5 times GDP and 2 times our national debt, that is the economy, and it's all that matters. And that is the next recession if it goes down, and more inflation if it goes up. It's part of an end game.
Given everything we've discussed so far, how would you approach portfolio construction and allocation at this point? Would you be literally sticking to T-bonds and cash? Is there anywhere else where you'd be allocated at present? Dry powder on the sidelines? What are your thoughts?
Yeah, I've mentioned be a prudent trader. Look for spots to buy and sell. Most notably, sell rallies. I can stick with that. I don't give investment advice, but compliance has never said I can't say overweight treasuries. So to me, that's the key thing to do this year: is way overweight treasuries. Potentially stick out for some duration that's more risk because I think that's where the value is going to be. That's just that 5% long bond should drop maybe 100 to 200 basis points. And if there's any time to get out of the market, like there's any time to get out of gold, silver, platinum, and palladium, it was in January, February. And some people I know, including myself, who've been in this stuff for decades, just said, yeah, thank you very much. It's a wonderful ride. And yeah, run through me. But this is a year to be just step back and wait. And I'd say always be careful hedging, because one lesson I've learned hedging, I've certain things is, what are you hedging? The opportunity just to keep for the train to keep the trees to keep going up like SpaceX all the way to the space and just keep going up, or are you just doing the prudent things and rebalancing? And to me, sometimes it's better to just rebalance and lighten up in things that went up a lot. Gold, silver, platinum, and not really silver. Palladium didn't so much because it put in its peak just a few years ago. But just lighten up, say thank you, and find stuff that that has value. And I see value in 5% long bonds.
Well, Mike, where can people go to follow more of your work? Tell us what you do as well at Bloomberg Intelligence.
Well, first on your show, thank you for having me, Jesse. On the Bloomberg Terminal, I'm on X at Mike McGlone 11, LinkedIn, Senior Commodity Strategist, Mike McGlone. People want to reach out, I'm happy to add to my distribution list. And I'm the Senior Commodity Strategist. My background is I started in the trading pits in Chicago. I've got a lot of degrees, not the smartest person in the world, but I study hard. But I'd like to say all that time I got master's degrees and things and CFAs and FRMs and stuff. It has nowhere comparison to what I learned just the 5 years I worked in the trading pits in Chicago in the 80s and 90s. That was a lifetime of information and knowledge and of gathering. It's shaped everything I do. It really helps make these views. For instance, when crude oil popped just a few months ago, I was adamant, like, I'll sell to you. Just because you see these things happen. And I used to be one of those traders. I know when I'd get stopped out, and I know when I was right. And a lot of times I know how to make and lose a lot of money trading futures because I've done it. And that basis really helps me make some decisions. A lot of wrong ones too, but that's what's so important. Admit when you're wrong and move on. And I've been wrong in stocks forever. I was wrong on gold for 4 years, and it finally broke out. And I've been long on bonds breaking out for about 3 to 4 years now, Jesse. So I think maybe it's time.
Great. Well, I'm going to put links in the description to your X as well as LinkedIn so people can follow your work there. Mike, great to have you on the show. Thank you so much.
Thank you for having me.
Thank you for joining us today, this Saturday, June 27th at 1 p.m. Eastern Time, the very first live commodity culture boot camp. I'm going to be opening up my portfolio A to Z, talking about which commodities I'm most bullish on ahead. By the way, I've got a very different view than the guest today, Mike McGlone, as you'll find out. I'm going to walk you through my strategy, my future outlook, and all of the wisdom and knowledge I've gained from the guests that have come onto this program. Sign up at join.jesseday.ca. Use the link in the description below, and I hope to see you there and in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.